So we'll now move on to reading number 41 of the level 2 curriculum that will tell us about publicly traded real estate securities. So as we studied earlier, publicly traded real estate includes equity REITs, that is real estate investment trusts, similar to mutual funds but investing in real estate and investing in income producing assets of real estate. We can also invest in real estate operating companies like DLF, Unitech, etc. that own and manage real estate. So if we are buying their shares, in a way, we are also investing in the real estate. So these are equity investments in real estate. Debt investments in real estate are similarly mortgaged backed securities, that is giving somebody a loan based on real estate, or investing in a pool of securities which are collateralized by or which are backed by real estate. As the value of real estate goes up, the probability of default on these securities goes down, or the value of these securities will go up. So these securities will also increase in value as real estate goes up. So investing in mortgage-backed securities or investing in REITs that invest in mortgage-backed securities, or known as mortgage REITs, can again be a debt-like investment in real estate, which will give us fixed returns and some appreciation as yields compress. The advantages of investing in publicly traded real estate as against private investments in real estate that we studied earlier is first and foremost superior liquidity, because these units would generally be smaller in value and can easily be traded. Lower minimum investment as in REITs, etc., because you're not buying the entire property. Everybody's pooling their money together and then we are buying property, so the minimum investment can be much lower. Limited liability. If you own the property and anything untowards happens in that property or because of that property, then all liability is of the owner. So in a publicly traded structure, your liability will be limited to the extent of the money that you have invested. At worst, you can lose all your investment, nothing more. Access to premium properties may be possible because people pool in together and they now have a lot more to invest that an individual, even with debt, may not be able to. Active professional management, protections accorded to publicly traded securities, the Securities Exchange Commission, the SEBI, etc., will all be there to protect your interests according to the laws. And greater potential exists for diversification. Private real estate would tend to be a big concentrated investment otherwise. If you're investing in REITs specifically, that is within publicly traded real estate also, if you're investing in real estate investment trusts, then there are certain advantages that REITs enjoy. First of all, there is exemption from taxation. So the profits that REITs make are not taxed, whereas corporate profits may be taxed and then dividends may be further taxed. But REITs have an exemption, so they give their money out tax-free. The individual may have to pay tax depending on his or own tax rate, but REITs don't levy a tax like corporates have to. Predictable earnings, because they normally are required to invest in income yielding assets and they are further required to pay out 90% of their earnings as dividends. So that adds a lot to the predictability in the cash flows and the earnings. And there's generally a high yield, as we discussed, because REITs are obligated to pay high dividends. 90% of their earnings has to be paid out as dividends in most cases. Disadvantages of public real estate against private real estate is first, tax benefits may not be as high. In private real estate, if you've taken debt, then a lot of exemptions are normally given under many jurisdictions. So direct ownership sometimes may have better or higher tax benefits. There is lack of control. You have to bear the costs of a publicly traded corporate structure. There's a special HR department, compliance department. A big company operating will have all these other expenses also that has also been borne by the shareholders. Price is determined by the stock market and sometimes irrational fluctuations can also happen. There may be a conflict of interest between the professional management and the shareholders or the unit holders of these companies or trusts. Limited potential for income growth is what has generally been seen, because they're invested in their REITs and etc. especially are investing in income producing properties, and growth will be inflationary or to some extent. So that extra or really high or really stupendous income growth may not happen to as big an extent as is possible with direct investing on one parcel of land. Often there could be a forced equity issuance if the company has taken on a lot of debt and now properties are not being sold. Then you may need to issue equity and dilute other shareholders in a publicly traded real estate. REITs specifically have lack of flexibility because they have to invest in income producing assets, pay off 90% of their income back to the shareholders or back to the unit holders. So flexibility in terms of investing in startup parcels of land, etc. is limited. Now, there can be various types of REITs. REITs investing in retail assets, office assets, rent producing residential assets, healthcare, hospitals, industrial assets, hotels, or warehouses. Each of these REITs will have their own considerations that will drive the value of the properties of the REITs and the rentals and the income that the REIT is generating. So the following table rates these factors from the most important to the least important for each of the REITs. So for a REIT investing in shopping malls or retail assets, the most important factor is retail sales growth or consumption growth. Job creation is the second most important factor. Population growth is also very important, and supply and demand is also considered equally important as population growth in determining the value for a shopping mall or a retail based REIT. So if a lot of malls are coming, then definitely that depresses value. So all these four factors are generally quite important in real estate, for any real estate. Just the relative positioning may go a little here and there. For example, for office buildings, it is job creation that is definitely the most important factor. If jobs don't get created, then there will be no requirement for office space. Demand and supply is also seen to influence the prices and rentals significantly. Population growth is important and retail sales growth is the least important. For residential real estate, the most important factor is population growth. Whether or not people have a job, they still need a place to live. Job creation, however, is also equally important. With better jobs, people can afford bigger houses and more demand for residential real estate. Demand and supply comes next, and retail sales growth is the least important factor. For healthcare REITs, again, population growth is very important. More people, more need for hospitals. Demand and supply is the second most important. Job creation is third, and retail sales growth is fourth. For industrial REITs or REITs investing in industrial parcels or industrial spaces, again, we see that retail sales growth is more important, because more growth, more manufacturing, more demand for expansion of capacity and industry. So retail sales growth is very important, followed by population growth, demand and supply, and job creation. For hotels, again, job creation is seen to be the most important factor, followed by demand and supply, population growth, and retail sales growth. So please note, you don't have to memorize this table for the exam. Do not really expect this to be tested, but just for your knowledge, you should understand that the prime factors you can remember, or the most important factor for each of these, you can try and remember, and otherwise just know that these are the four factors that impact the value of any real estate the most. For warehouses and storage type REITs, so these are REITs investing in companies or properties that provide storage. So everybody needs storage space. Storage, we need lockers, high valuables of people, they don't want to store in their house, so they want to, or there are designated places which are secure and safe, whose job is only to provide storage of valuable items. So storage REITs or REITs investing in these properties, and of course they charge a fees for providing that space. Population growth is seen to be very important, followed by job creation, demand and supply, and retail sales growth. So once again, Let's understand the investment characteristics of REITs. As discussed, they're exempt from corporate level income taxes. Because they have a restriction of paying 90% of their income or a high amount of their income back as dividends, the dividend yield tends to be high, income volatility is lower, and they often do secondary equity offerings to raise more money to invest in newer assets. So they don't retain a lot of money, they pay it out as dividends. So if they want to acquire newer properties, they often do need to do secondary equity offerings. Principal risks of REITs: mismatch of demand and supply in the properties that they have invested in will result that rentals are not that high and income will not come. The other risks of any commercial or leased out property will all also apply to REITs. So financing, leasing, location, quality of the property are all important factors that need to be considered before investing in a particular REIT. So you must see that what kind of areas does the company invest in, where does this REIT have assets, and what are the prospects for those properties. Just like we saw the due diligence checkpoints for private real estate, the due diligence checkpoints that must be checked for REITs or public real estate include remaining lease terms. Is there inflation protection clause built in the lease agreements? So is the lease constant, or will the lease keep increasing every year or every 3 years in line with inflation? What are the in-place rents vis-a-vis the market rents? So what is the rent that has been locked in as against the market rent? If the market rents are much lower, then that's a problem. If market rents are much higher than the current rents, then that's a good thing, because sooner or later the rents will get revised to these market rates. Costs to release the space, the brokerage, etc., that will have to be paid. Tenant concentration in the portfolio. If there is just one big tenant in the building, then the risk is higher, because if he exits, then the whole building will have to be vacant or will have to be leased out again. The tenant's financial health, new competition or new buildings coming in the area. The balance sheet of the REIT is important to see. What kind of assets does it have? What kind of liabilities does it have? How much debt has been taken? So that you know whether an equity offering is likely or what is the income that you can expect. And very importantly, you need to have a judgment on the quality of management of the REIT. In the coming 2 slides, we'll just summarize the various subtypes of REITs that you can invest in, or you can potentially invest your client's money in. So in a retail or shopping REIT, as we saw, the retail sales growth was the most important factor, followed by job creation. Investment characteristics include stable revenue over the short run, and then there may be fluctuations depending on these 2 factors. Principal risks is the slowdown in consumer spending. If that happens, rentals will fall. Due diligence considerations, all that we studied earlier, are important, but you should definitely check for the per square feet price and the rental rates that are prevailing. For office REITs, the determinant of value is job creation and the new space supply versus demand. Investment characteristics, again, normally a long lease, so 5 to 25 years is the lease terms of office REITs or office properties. So this also generally provides us stable year-to-year return. Principal risk is the changes in office vacancy and hence a reduction in the rentals. For due diligence, you must check the other offices coming in the vicinity, and you should check the quality of office space, whether it is A grade or B grade. Is it built to modern standards? The cost of maintenance, etc., are low or not. So good quality office buildings in the same area can have a much higher value than bad quality corporate office buildings. For residential property, the most important thing is population growth, followed by job creation. These are generally 1-year leases or 2-year leases, so they are not as long term as shopping or office REITs or office properties. Again, gives us a stable return, however can fluctuate a little more than office properties and shopping properties, the residential leases. Principal risks again include the other apartments and other competition coming in the area. So residential property will be very dependent on that particular region or that particular location. So what are the dynamics of that particular location need to be considered and understood very well in order to build our expectations for residential property. Inflation and operating costs will also normally cause rentals to go up, or if rentals are fixed but operating costs are going up, then again the value or the net operating income may reduce. So for due diligence, try to understand the demographics, that is the job creation, income trends, age and competitive appeal of the property. See the cost of home ownership. If that is not very high, then people may not rent, they will just simply purchase their own houses and pay an EMI or pay a financing cost. See the rent controls, if any, in place. A lot of time governments put a limit on the maximum rent you can charge. If anything like that is there, then again the value of the rent may not go up and the value of the REIT may not go up. Healthcare REITs again invest in hospitals and healthcare properties. So population growth and demand and supply are the key determinants. So these REITs lease facilities to healthcare providers, and leases are usually net leases. That is, the rent is decided net of all operating expenses. In residential REITs, it is normally it can be a gross lease. That is, the tenant pays the gross amount and then the landlord pays the maintenance and the taxes. In the case of healthcare, it is usually a net lease. So that is the net amount that comes to the landlord after the payment of all maintenance and taxes, etc. Again, changing demographics, withdrawal of government funding or additional government funding to healthcare companies will all increase the demand for these properties or reduce the demand for these properties. Construction cycles can be long. Financial condition of operators must also be checked so as to be sure that a regular rent stream will come. And if there is some litigation against the hospital for some negligence case or some other case, then again it may be a problem for you as rents may not come for a period of time. Due diligence considerations again in line with the risks. So see the operating trends, the operating profits of the hospitals, the government funding trends, litigation settlements, insurance costs, and the competitor's facilities versus the demand. So if he has too much high equipment and high costly means of treating patients which is not really in demand, then again the profitability of the tenant may not be very high. Industrial REITs, as we saw, retail sales growth was the most important factor, because if consumption grows, then there will be more demand for products and there will be more demand for these kind of REITs, followed by population growth. So these REITs again tend to be less cyclical, and 5 to 25 year net leases are what are signed. So again, like office leases, the stability in value or stability in rentals from these REITs is relatively higher. And fluctuations tend to be low. Risks include the shifts in composition of local and national industrial bases and trade. So if all traders are shifting to a new position, for example from Nariman Point everybody is shifting to BKC, then the demand for industrial in that particular area may go down. So again, when investing in industrial REITs, check the tenant's requirements and check if this REIT has that kind of properties that which tenants want. If they do, then demand will be higher and rentals will be higher. Check for obsolescence of existing space. So if this is an old building or an old type of industrial property or industrial location, then again it's becoming obsolete and people will not move to this location. New types of space, proximity to transportation, trends in local supply and demand are all some considerations that should be checked before investing in industrial REITs. Similarly, REITs investing in hospitality or Hotel properties would be classified as hotel REITs. Job creation and supply and demand will be the determinants of value. So these REITs generally tend to have variable income because income would be a revenue share plus a minimum guarantee. So for REITs, renting or letting out properties to hotels and hotel operators would generally have a more variable income than office leases or industrial leases as the income of the hotel property changes. So this sector is cyclical and generally leases are not very long term. There will be 3 to 4 year leases with a revenue share. Principal risks exposed to the business cycle, change in business and leisure travel will all impact hotel properties and hotel leases. And of course, if there is a typhoon or a plane crash or some terrorist threat, etc., then again these travel disruptions will all impact the profitability of hotels and the value of a hotel REIT. Due diligence considerations: you have to understand the occupancy, room rates, the operating profits and the margins vis-a-vis the industry averages of the leases that this REIT has entered into, the revenue per available room, the trends in forward bookings, maintenance expenditures, new hotels coming up in the vicinity and the operating leverage all need to be understood so as to get a sense of the profitability of the tenant and the expected rentals in the future. Finally, storage REITs provide storage space for a fee or for a charge. Population growth means more storage requirement and will be a determinant of value. Similarly, job creation. So space is generally rented on a gross lease. That is, the client pays a fixed amount. The maintenance expenditures, taxes, insurance, everything is borne by the landlord or by the REIT itself. So this space is on a gross lease and normally rented on a monthly basis. So the entry barriers are not very high in the business. So if more people come in, more banks set up, then more storage space may be available, and hence the value of competing properties or competing storage spaces may go down. So you must check for the construction of new competitive facilities that are providing storage, trends in housing sales, demographics, new business activity, and there have seen to be some seasonal trends in the demand for storage in some markets. So people shift their houses at a particular time and they have more storage requirements at some particular months than others. So all that needs to be analyzed before investing in storage REITs. So not very important, all these characteristics. You must go through them once. Closer to the exam, just watch the video once again so that you revise all the characteristics of the REITs. If a question comes with 3 choices available, it will normally not be a big problem trying to answer a question on the qualitative characteristics of REITs. Now, a very important computation done for REITs is termed as the net asset value per share. As the name suggests, it is the value of the assets minus the value of the liabilities divided by the number of units outstanding or the number of shares outstanding. So Sandy, an analyst, is undertaking a valuation of ABC Incorporated. Given the following financial data, estimate the net asset value per share based on forecasted cash net operating income. So select financial information for ABC is given. The last 12 months net operating income is $150. Cash, receivables, debt, liabilities are given. Question also mentions that non-cash rent is there to the tune of $10. Please remember that we give a multiple and we discount the cash flows in our valuations or in all income-based approaches. So non-cash rent is generally going to be knocked off from the total rent. A lot of times in the question, it will specifically be mentioned that cash NOI is so much. If the question already says cash NOI, then don't double subtract the non-cash rent even if it is given. So here it is the 12 months NOI That is the total NOI. And hence the non-cash rent will have to be subtracted. There are also some full year adjustment for acquisitions that need to be done. So the rent was distorted to some extent because some property was acquired in the middle of the year or after 1 month or 2 months. So that's why the full NOI of that property has not come in this year's rent. So again, we want to give a multiple to the full year's cash flow. So we will add or we will adjust for these acquisitions that were made during the middle of the year so that we see the impact of the full rental from that property. So 150 minus 10 plus 4 is the rent that should be given a multiple. This rent is expected to grow at the rate of 1.5% and the cap rate is given to be 6.5%. Cap rate, as we studied earlier, is something like KE minus G. The value of the property is D1 upon KE minus G, not D0 upon KE minus G. So this was the last 12 months rent, that is 150 minus 10 plus 4, that is equal to $144. So the value of the property from the rent would be calculated as 144 into 1 plus 0.015 divided by KE minus G, that is divided by the cap rate of 0.065. So this will be the value of the property plus the value of all other assets, that is cash, accounts receivable, minus the value of liabilities. So debt will be subtracted, other liabilities will be subtracted, land held for future development will be added, other assets will be added, to get to the net asset value divided by the number of shares in millions will give you the NAVPS, that is the net asset value per share. So please tell me the net asset value first. So the net asset value after adding and subtracting the other assets and liabilities comes out to be 1513.6. For 25 million shares outstanding, the net asset value per share will be 1513.6 divided by 25, that is equal to $60.54. Two other cash flow metrics that are very important for REITs include the funds from operations and the adjusted funds from operations. So funds from operations adjusts reported earnings and is a popular measure for the continuing operating income of a REIT or a real estate operating company. Funds from operations is calculated as follows. Start with the net earnings, add back the depreciation expense, add back any deferred taxes, subtract the gains from sales of property and debt restructuring, if any, because we want operating items. So any one-off gains or other gains need to be subtracted and any other losses need to be added back. So losses from sales of property and debt restructuring need to be added back. This will give us the funds from operations. Please note it's not exactly the same as cash flow from operations, although the idea is similar. So you must try to remember this formula. It is the net earnings plus depreciation plus deferred taxes. Deferred taxes are a liability. So that liability goes up. It's a cash inflow. So plus deferred taxes minus gains plus losses from sales of property and debt restructuring. Adjusted funds from operations will start from the funds from operations, that is, it will start from FFO minus the non-cash rent adjustment minus recurring maintenance type capital expenditures and leasing commissions. So the adjusted funds from operations will further reduce the non-cash rent and it will further reduce capital expenditures which we see are recurring in nature. So if a repair is being classified as a capital expenditure, But if we see that this repair is needed every year, then we will also subtract this from the funds from operations to get a better sense of the cash flows from operations. So again, start with FFO minus non-cash rent minus recurring capital expenditures or recurring commissions that we are paying every year. So this will give us the adjusted funds from operations. Cindy is an asset manager that is interested in diversifying the portfolio she manages through an investment in an office building REIT. Cindy wants to value the potential investment using 4 different approaches as of the end of 2013. First, she wants to compute the net asset value like we just did. Then, and like is popularly checked for REITs, is the price to funds from operations and the price to adjusted funds from operations. So both these ratios we want to compute across REITs and across different companies. And finally, we want to compute the value using a DCF or a discounted cash flow approach. So the first approach asks us to calculate the net asset value. Now, the estimated 12 months cash net operating income is given. First of all, it's not the last year's. The next year's is already given, so no growth rate needs to be applied. And secondly, this is the cash net operating income. So non-cash rents, even though they may be given, are not required in the question. Be careful that you don't make this mistake. So 200 is already given. You do not need to subtract the non-cash rent. So on 200, we will apply a cap rate that is given to be 10%. That is divided by 1 to compute the value of the property or the value of the rents. That comes out to be $2 billion or $2,000 million. We can then add the cash and cash equivalents, add the accounts receivable, subtract the debt and other liabilities, and that will give us the net asset value. So the net asset value comes out to be $1370 million or 1370 divided by 20 million shares. Now this will be the NAV per share, that is 68.55. The second approach asks us to calculate the value using the price to FFO multiple. The funds from operation are given to be 170 million and the average price to funds from operation multiple is given to be 15 times. So the value using the funds from operation approach would be 170 multiplied by 15. That comes out to be $2550 million or 2550 divided by 20 million shares will be the per share value from the price to FFO approach, which comes out to be 127.5. The third approach is referred to as the price to adjusted fund from operations. So we will first try to compute the adjusted funds from operations. So we'll start with the funds from operations and subtract any non-cash rent. So the non-cash rent is given to be 15 million and we'll subtract the maintenance type capital expenditures, that is 35 million, to give us the adjusted funds from operations as 120. The price to adjusted funds from operation multiple is 20 times. So we'll multiply it with 20 to get the value, which comes out to be 2,400 million, and then we divide by 20 million shares, we'll again get a value of $120 per share. The last approach is the DCF or a dividend discount model. So we'll explicitly project the cash flows and discount them back. So for that, what is given is that the expected dividend next year is $10. Dividend growth rate for the next 2 years is 5%, and from 2017 till perpetuity this is 3%. The cost of capital is given. The risk-free rate is given. That is not really needed because the cost of equity capital entirely is given. So 12% is the cost of capital. The dividend next year, that is t equal to 1, will be $10. T equal to 2 would be 10 into 1.05, that is 10.5. Dividend at t equal to 3 would again be 10.5 into 1.05, because for the next 2 years it will grow by 5%, that is 11.025. And from t equal to 3 onwards, the growth is a sustainable 3%. So 11.025 is sustainably going to grow at the rate of 3%. So we can apply the Gordon growth model or the dividend discount formula right at t equal to 3. So 11.025 divided by KE, this we can assume as D1. So this upon KE minus G, where KE is 0.12 minus 0.03, will give us the present value at t equal to 2. So the total value of the property would be 10 divided by 1.12 and 10.5 plus this value from the Gordon growth model divided by 1.12 to the power 2. So please verify that the present value at t equal to 0 will come out to be 114.95. Since we are working with per share data, the expected dividend is given on a per share basis. We don't need to further divide it by 20 million. So from the fourth method, that the DCF method, the value comes out to be 114.95. So that was about the review on publicly traded real estate investments. In the next session, we'll study about hedge funds and widen up the discussion on alternative investments. Thanks a lot.